Hi there. In this video, we'll explain how company shares are valued for inheritance tax and why directors often face costly HMRC valuation disputes.
A family-owned business valued at £4 million passes to the next generation. For decades, this transfer generated zero inheritance tax. Today, that exact same transfer can trigger an unexpected £300,000 tax liability. The April 2026 budget introduces a hard cap on business property relief. The era of unlimited tax immunity for trading companies is over. We are My Tax Accountant. We guide UK directors and business owners through complex compliance and corporate tax strategy. This analysis deconstructs the director's estate. We will examine company share ownership, theoretical market valuations, and the impending disputes with tax authorities over what a business is actually worth. We will calculate the value of unquoted shares, isolate the hidden trap of accepted assets, and map the precise mechanics of the new £2.5 million relief cap. Passive tax shielding is obsolete. Protecting corporate wealth requires actively defending your company's valuation against strict audit standards. Consider a case study. Sarah is a UK company director holding a 60% stake in a highly profitable manufacturing firm. The company's total equity is currently valued at £4 million. For inheritance tax purposes, her shares are assessed using open market value. Under Section 160 of the Inheritance Tax Act 1984, this is the exact price negotiated between a hypothetical willing buyer and a hypothetical willing seller. HMRC enforces these valuations through their Shares and Assets Valuation Team, or SAV. They scrutinize every discount and premium applied to the estate. This diagram illustrates how minority discounts work. A shareholder with a 25% stake cannot force dividends or control management. To reflect this lack of control, SAV routinely accepts a 30 to 45% reduction in the taxable value of those shares. Sarah, however, holds a 60% controlling stake. Because she dictates company policy, her shares receive no valuation discount. The estate is taxed on the full proportional value. Spreading shares across a family does not automatically solve this. Under the related property rule, if a husband holds 40% and a wife holds 20%, HMRC groups their shares into a single 60% block upon death, denying minority discounts to both. Retaining a controlling interest ensures operational dominance during a director's lifetime, but it maximizes the taxable value of the estate upon death. To access business property relief, a company must pass the Section 105(3) wholly or mainly test. This scale shows the requirement. A business must consist of more than 50% trading activity rather than investment activity. Sarah's manufacturing firm passes easily. A freelance consultancy passes. However, a buy-to-let property portfolio is classed as holding investments and fails the test completely. For hybrid businesses containing both trades and investments, HMRC applies the Farmer-Balfour test. Auditors evaluate the company's turnover, track the operational net profit, analyze capital asset allocation, and the time spent by directors to determine the primary business nature. Furnished holiday lets are particularly vulnerable. Despite generating rental income, they routinely fail the trading test unless the owner provides intensive, hotel-level services. Passing the trading test clears the first hurdle. It secures access to the relief framework, but it does not shield every asset sitting on the company's balance sheet. Under Section 112, assets held by a company that are not used for the business lose their tax-free status. This is known as the accepted assets trap. This balance sheet reveals the most dangerous accepted asset for a profitable private company: surplus cash. Sarah's firm holds £800,000 in cash reserves. During an audit, SAV calculates the firm's actual working capital requirements. Based on turnover and liabilities, they determine only £300,000 is required for current business operations. The remaining £500,000 is reclassified as an accepted asset. It is immediately stripped of business property relief and exposed to taxation. To defend against this reclassification, directors must produce formal board minutes documenting specific, near-term plans for excess cash, such as acquiring new machinery or expanding facilities. Directors' loan accounts present a similar risk. If a director dies owing the company money, that outstanding debt becomes a highly visible, taxable asset within their personal estate. Operating a legitimate trading company provides no shelter if directors treat the corporate balance sheet as a personal holding account. Parliament's recent legislative updates have introduced a hard mathematical ceiling to these valuation rules, taking effect in April 2026. This waterfall chart tracks Sarah's final tax position. Her 60% stake in the £4 million firm is worth £2.4 million. After subtracting her proportional share of the accepted assets, her final qualifying value lands at £2.1 million. The April 2026 legislation dictates that 100% relief is strictly capped at £2.5 million per individual. Any qualifying business value above that limit receives only 50% relief. Sarah's £2.1 million qualifying value fits entirely under the cap. Her shares pass to her beneficiaries without triggering an inheritance tax liability. Now we scale the scenario. If her qualifying share was £3.5 million instead, a massive £1 million block breaches the threshold and loses full protection. That £1 million excess receives only 50. Retrospective arguments with HMRC over unquoted share values are costly and time-consuming. Directors must audit and adjust their corporate structures now, rather than waiting for the 2026 legislation to take effect. My tax accountant provides rigorous, independent valuations and tax structuring for UK directors. Call us at 0208-570-8531. Reach out via email or visit our website. Subscribe to this channel for ongoing technical updates. This video is for educational purposes only and does not constitute formal tax advice. Always consult with a qualified professional regarding your specific financial circumstances. Blind reliance on historical tax exemptions leaves your legacy exposed. Proactive planning is now a strict requirement for UK business owners.